Hi, today I would like to talk about a momentum indicator known as the Relative Strength Index, or the RSI. We shall look at the applications as well as the principles behind this popular indicator. The RSI is a momentum oscillator that measures the speed and change of price movements. It is calculated using this formula here, where the RS refers to the average gain divided by the average loss. The purpose of this RSI is to detect the overbought and the oversold positions. When RSI is below 30%, the stock is in oversold position, and when RSI is above 70, the stock is in overbought position. As you can see in this chart, RSI works very well for this particular stock. The reason is because RSI works best in a horizontal trend. However, in a trending scenario like this one, if you sell at the overbought position when RSI is greater than 70%, you may find yourself in a difficult position to buy back later as the stock keeps moving higher. Similarly, in a downtrend like this one, if you think you are buying at the bottom when RSI is below 30%, then you will be disappointed, as most likely you are catching a falling knife. So how do we solve this problem? One way is to draw trend lines. If you see a rectangular chart pattern like this one, then it would be quite safe to use the RSI here. But once you see a breakout, you need to be careful when using the RSI, as the trend may be changing from a horizontal trend to a trending scenario. Next, we look at the principles of the momentum indicator. The first principle is that the oscillators move in the direction of the primary trend. If the primary trend is bullish, the RSI should see higher high and higher low, which is the definition of the uptrend. Similarly, if the primary price trend is bearish, we shall see lower high and lower low at the oscillator as shown in the diagram. Second principle is that divergence signifies possible trend reversal. In this chart, we see that while the upper price trend is trending higher, the bottom oscillator is having lower high and lower low. This is called divergence. When you see divergence, it may signify trend reversal. The third principle of momentum is that divergence must be confirmed through trendline violations, price patterns, moving averages, and other indicators. Back to this chart, we see that the divergence is confirmed by the violation of the price trend line, which satisfies this principle. As a result, price fell in two occasions as shown in the chart. The last principle of the momentum is that oscillators can plot trend lines and price patterns too. For example, you can plot trend lines and channels as shown in this chart, or you can identify the triple bottom or double bottom as shown in this chart. In other words, you can apply the principles of technical analysis in the oscillator as well. In summary, RSI is more reliable in a horizontal trend. We can apply RSI together with trend lines and chart patterns. And finally, it is important to observe any divergence between the price and oscillator. Thank you for watching. I hope you find this YouTube video useful.